The secret rise of BlackRock, the company that owns the world origins of a giant. In the late 1980s, Wall Street was still reeling from the financial chaos of the decade. The junk bond bubble had burst, several banks were in turmoil, and the world of investing was shifting into uncharted territory. It was in this environment that a small group of financial professionals began to work on an idea that would eventually change the very structure of global capitalism. The heart of this story is a man named Larry Fink. Today, his name is associated with power, wealth, and global influence. But in the mid-1980s, Fink was a young executive at First Boston, one of Wall Street's leading investment banks. He had made a name for himself by pioneering mortgage-backed securities, an innovative but risky financial product that bundled home loans and sold them to investors. For several years, Fink was a rising star. His division made billions for First Boston. He was celebrated as one of the most brilliant minds of his generation. But in 1986, disaster struck. A miscalculation in interest rate risk caused his department to lose hundreds of millions of dollars. Practically overnight, Larry Fink went from being one of Wall Street's brightest young minds to a man whose reputation was severely damaged. It was a lesson he would never forget. In his own words, the failure taught him one crucial thing: risk management was everything. Without it, even the most sophisticated financial empire could collapse in an instant. That realization would become the foundation of the company he would build a few years later, BlackRock. The birth of BlackRock in 1988. Larry Fink, together with 7 partners, left their corporate careers to start a new venture. Their vision was to create a firm that combined the discipline of risk management with the innovation of asset management. The company they founded was small, modest, and initially just a spin-off within Blackstone, the private equity firm run by Stephen Schwarzman. The new company was called BlackRock. At first, it wasn't even independent. BlackRock started as part of Blackstone's empire, focusing on fixed income management. But unlike most asset managers of the time, Fink and his team weren't just buying and selling bonds. They were developing advanced models to measure, track, and control risk. This was revolutionary. In the financial industry of the late 1980s, risk was often treated as an afterthought. Firms were focused on returns, profits, and growth. Few took the time to understand the hidden dangers inside their portfolios. Fink saw that gap and decided to fill it. Within just a few years, BlackRock became known for its sophisticated risk management technology. Their systems could track thousands of assets across different markets, calculating potential losses under various economic scenarios. For institutional investors, pension funds, insurance companies, and governments, this was invaluable. BlackRock wasn't just managing money. It was managing certainty in an uncertain world. Breaking away from Blackstone, but as BlackRock grew, tensions with Blackstone began to surface. Schwarzman was focused on building his private equity empire, while Fink was more interested in creating a global asset manager. The visions clashed. By 1994, BlackRock split from Blackstone, becoming an independent company. It was still small compared to Wall Street giants, managing just a few $billion. But the seeds of future dominance were already in place. BlackRock had 2 key advantages: a relentless focus on risk management that a client base of large institutions that trusted their methods. Over the next decade, these strengths would propel the firm into a position few could have imagined: the secret weapon. Aladdin. At the core of BlackRock's rise was something called Aladdin, an acronym for Asset, Liability, Debt, and Derivative Investment Network. Developed in the 1990s, Aladdin was more than just a financial software. It was a complete risk management and trading platform that became the backbone of BlackRock's operations. Aladdin could simulate thousands of scenarios for global markets. It could track the tiniest changes in interest rates, currency fluctuations, or bond defaults, and show how they would impact a portfolio worth billions. For investors, it was like having a crystal ball into the financial future. Soon, Aladdin wasn't just being used by BlackRock. Other institutions began licensing it. Today, it is estimated that over $20 trillion worth of assets around the world are monitored by Aladdin. That means governments, banks, corporations, and even rival asset managers rely on technology controlled by BlackRock. Through Aladdin, BlackRock didn't just manage its own money. It gained visibility into the global financial system itself, By the end of the 1990s, BlackRock was still far from the giant it would become. But the foundation was solid: a disciplined culture, a revolutionary technology, and a leader who had learned from past failure that survival depended not on bold bets, but on understanding and controlling risk. And then came the 2000s, a decade that would change everything. The age of crises. At the dawn of the 21st century, BlackRock was steadily expanding. But it was still a niche player compared to Wall Street titans like Goldman Sachs, Merrill Lynch, and Citigroup. While these giants were making headlines with massive deals and record profits, Larry Fink was focused on something much less glamorous: discipline and survival. This focus would soon prove prophetic. The 2008 financial meltdown. The first years of the new millennium brought turbulence. The dot-com bubble had burst, followed by the shock of 9/11, and then the wars in Afghanistan and Iraq unsettled global markets. But none of these events compared to what was coming in 2008. The housing bubble, fueled by subprime mortgages, Wall Street greed, and reckless risk-taking, was about to collapse. As banks packaged risky loans into complex securities, they convinced themselves that these products were safe. Ratings agencies stamped them as AAA, investors poured in money, and the illusion of prosperity spread across the globe. But beneath the surface, the system was rotten. When the bubble burst, the consequences were catastrophic. Lehman Brothers collapsed. Bear Stearns had to be rescued. Merrill Lynch was sold in desperation. Even titans like Citigroup and AIG teetered on the brink of extinction. Governments around the world scrambled to prevent total economic collapse. And in the middle of this chaos, BlackRock was called in as the firefighter of Wall Street. BlackRock becomes Wall Street's fixer. Unlike many banks, BlackRock had avoided heavy exposure to subprime mortgages. Its culture of risk management had kept it from making the most reckless bets. As a result, when the crisis hit, BlackRock stood strong while competitors crumbled. But its real leap forward came from its expertise. The U.S. government and the Federal Reserve needed someone to unwind toxic assets, the complex securities that had triggered the meltdown. Who had the tools, technology, and credibility to do it? The answer was BlackRock. Larry Fink and his team were given extraordinary responsibility. Through its Aladdin system, BlackRock analyzed the toxic portfolios of Bear Stearns, AIG, Freddie Mac, and Fannie Mae. In some cases, it was literally deciding the fate of the global financial system. By helping the U.S. government manage and value billions in toxic assets, BlackRock cemented itself as the most trusted name in finance. To many, it was no longer just an asset manager. It was becoming the operating system of global finance. The Barclays deal. In 2009, another opportunity arrived. Barclays, the British banking giant, needed to sell part of its asset management arm to raise cash. BlackRock saw its chance. For $13.5 billion, it acquired Barclays Global Investors, BGI. This single deal transformed BlackRock overnight. Not only did it double the firm's size, but it also gave it control of iShares, the largest provider of exchange-traded funds, ETFs, in the world. That ETFs were revolutionary. Unlike traditional mutual funds, ETFs allowed investors to buy shares that tracked entire indexes, like the S&P 500, at extremely low fees. It was passive investing on a massive scale, and it was exploding in popularity. With iShares under its control, BlackRock didn't just enter the ETF market, it dominated it. Within a few years, it became the unquestioned leader in passive investing, controlling trillions of dollars. The new face of power. By 2010, BlackRock was no longer the quiet risk manager of Wall Street. It had become the largest asset manager in the world, overseeing more than $3 trillion in assets. Its reach extended into every corner of global finance: pensions, governments, corporations, and individual investors. But perhaps its greatest power lay in something less visible. Through Aladdin, BlackRock could see risks across the financial system that few others could. Governments and banks relied on it. Rival firms licensed its technology. BlackRock was no longer just another financial company. It was the invisible hand behind the markets. The criticism begins with power came scrutiny. Some critics began to argue that BlackRock was becoming too powerful. Its ETFs gave it large ownership stakes in thousands of companies, from tech giants like Apple and Microsoft to oil companies, banks, and even defense contractors. By controlling so many shares, BlackRock could vote on corporate policies, executive pay, and even climate strategies. Larry Fink, once a banker disgraced by a bad bet in the 1980s, was now one of the most influential voices in global business. Supporters praised BlackRock for its steady hand and focus on long-term stability. Detractors warned that concentrating so much financial power in one company was dangerous for democracy and the free market. But whatever the debate, one fact was clear. After the 2008 crisis, BlackRock had risen from a mid-sized player to the undisputed king of Wall Street by the early 2010s. BlackRock was not just managing money, it was shaping the future of capitalism itself, and soon, it would move beyond finance into areas once thought untouchable: politics, climate policy, and even the governance of nations. The shadow ministry of finance. By the 2010s, BlackRock had already achieved what no other financial institution had done before. It became the largest asset manager on the planet, with trillions of dollars under its control. Yet, size was only part of the story. What truly distinguished BlackRock was its unique role as a trusted advisor to governments. When financial crises struck, when central banks needed guidance, when countries faced the collapse of their institutions again and again, they turned to Larry Fink and his team. It was a remarkable transformation. BlackRock was no longer just a private company. In many ways, it had become a shadow ministry of finance, advising presidents, prime ministers, and central bankers. The European debt crisis in 2010, Europe faced a catastrophe of its own. Countries like Greece, Portugal, and Spain were drowning in debt. Their economies were collapsing. And the euro, the very currency of the European Union, was at risk of imploding. Governments needed help assessing the toxic assets of their banks and restructuring their financial systems. Once again, they called BlackRock. Through its Financial Markets Advisory Unit, BlackRock advised the European Central Bank and several national governments. Using its Aladdin system, it dissected the balance sheets of banks, determined the value of bad loans, and provided roadmaps for recovery. For ordinary citizens of Europe, BlackRock's name was unknown. But behind closed doors in Brussels, Frankfurt, and Athens, it was becoming one of the most important players in the fate of the continent. The company behind the curtain. By now, BlackRock's power came from more than just money. Its passive investing empire, built on iShares ETFs, meant it was automatically one of the largest shareholders in nearly every major corporation in the world. Consider this. If you bought an index fund that tracked the S&P 500, you were essentially giving BlackRock the right to vote on your behalf at shareholder meetings. Multiply that by millions of investors, and suddenly BlackRock held decisive stakes in companies like Apple, Microsoft, ExxonMobil, JP Morgan, Amazon. This gave BlackRock the ability to influence corporate strategies on climate change, labor policies, and executive compensation. In theory, it was simply carrying out the will of its clients. In practice, Larry Fink and his team became kingmakers of the corporate world. Letters from Larry. Every year, Larry Fink writes a letter to the CEOs of the world's largest companies. At first, these letters received little attention. But over time, they became some of the most powerful documents in global business. Fink began pushing for sustainable investing, urging companies to focus not just on short-term profits, but also on climate change, diversity, and long-term governance. In one letter, he famously declared that climate risk is investment risk, signaling that BlackRock would begin shifting trillions of dollars away from fossil fuels and into renewable energy. Supporters applauded him for using his influence to fight climate change. Critics accused him of woke capitalism, arguing that unelected financiers should not dictate social policy, but whether loved or hated. One thing was clear: when Larry Fink spoke, the boardrooms of the world listened. Entering politics by the mid-2010s, BlackRock's influence had reached directly into the halls of political power. Former government officials were hired into its ranks. Former BlackRock executives took positions in government. The lines between Wall Street and Washington grew increasingly blurred. During the Trump administration, BlackRock was less visible. But when the COVID-19 pandemic hit in 2020, its role expanded in ways never seen before. As global markets collapsed in March 2020, the U.S. Federal Reserve needed to act quickly to stabilize the economy. Who did it call to help design and execute its emergency bond buying program? BlackRock. The Fed gave BlackRock the task of managing trillions of dollars in purchases of corporate and government bonds. This meant that during the greatest financial shock of the century, BlackRock was not only stabilizing markets, it was effectively running part of U.S. monetary policy. The rise of the trillion-dollar manager by 2021, BlackRock's assets under management had surpassed $9 trillion, an amount larger than the GDP of almost every country on Earth except the US and China. IT wasn't just a company anymore. It was an empire, quiet, faceless, and spread across the global economy. Its critics warned, if BlackRock is too big to fail, then the entire financial system is hostage to one private company. But its defenders argued, if BlackRock didn't exist, we'd have to invent it. No one else has the tools to manage risk at this scale. By the end of the 2010s, BlackRock was more than just a financial firm. It was the nerve center of global capitalism, with the power to shape markets, governments, and even the future of the planet. And yet, with this power came something Larry Fink could not ignore: growing suspicion, conspiracy theories, criticism from politicians, and fears of monopolistic control began to follow BlackRock wherever it went. The backlash by the early 2020s. BlackRock was no longer just an asset manager. It was an invisible giant that touched almost every corner of the global economy. But with size and influence came resistance. For decades, BlackRock had operated quietly in the background, known only to financial insiders. Now, its name was appearing in headlines, political debates, and even protest signs. To many people, it symbolized something unsettling: the concentration of global power in private hands. The housing market controversy. One of the first major waves of backlash came from the housing market. In the wake of the 2008 crisis, millions of Americans lost their homes. Hedge funds and investment firms began buying up foreclosed houses in bulk. Among them, BlackRock was accused of becoming one of the biggest corporate landlords in the U.S. Reports emerged of entire neighborhoods being bought by investment groups tied to BlackRock or its subsidiaries. Families complained that they were being outbid by corporate buyers paying in cash, driving up prices and turning single-family homes into rental properties. Critics asked, was the dream of homeownership being stolen by Wall Street? BlackRock denied that it was directly responsible for the trend, pointing out that its ownership of single-family homes was small compared to the total market. But perception mattered. To many ordinary people, BlackRock had gone from being an invisible money manager to a villain in their daily lives. The woke capitalism debate at the same time. BlackRock's push for environmental, social, and governance (ESG) investing ignited a political firestorm. Larry Fink's annual letters to CEOs, once seen as thoughtful guidance, became lightning rods for controversy when he declared that climate risk is investment risk and pledged to reduce BlackRock's exposure to fossil fuels. Environmentalists praised him. But oil-producing states like Texas accused BlackRock of waging war on their economies. Some politicians branded BlackRock as the face of woke capitalism, a company that was using its financial power to force progressive values on the corporate world. Others accused it of hypocrisy, pointing out that BlackRock still invested heavily in oil and gas companies despite its climate rhetoric. Caught in the middle, Larry Fink tried to balance competing pressures: shareholders demanding profits, governments demanding stability, and activists demanding change. But the louder his voice grew, the more polarized the response became. BlackRock and China. Another source of controversy was BlackRock's expansion into China. In 2021, it became the first foreign firm allowed to run a wholly owned mutual fund business in the country. Fink saw this as a historic opportunity: access to the savings of hundreds of millions of Chinese citizens. But critics in Washington sounded the alarm. How could a U.S. company that claimed to care about democracy and human rights invest so heavily in a country accused of surveillance, censorship, and authoritarian control? Even billionaire George Soros, himself a major figure in global finance, publicly criticized BlackRock, calling its China strategy a tragic mistake. But BlackRock pressed forward, arguing that ignoring the world's second-largest economy was impossible. Conspiracy theories with great size came not just scrutiny, but myths. Conspiracy theories began circulating online, painting BlackRock and its rival Vanguard as puppet masters secretly controlling the world. Infographics went viral, showing how BlackRock and Vanguard own large stakes in thousands of companies, including media outlets, defense contractors, and pharmaceutical firms. To some, this looked like evidence of a global cabal. In reality, much of this was a byproduct of passive investing. By creating index funds, BlackRock automatically became a top shareholder in countless companies. But while its voting power was real, the idea that it secretly orchestrated every move of the global economy was exaggerated. Still, the perception stuck. BlackRock, once a name unknown to the public, was now being cast as a shadowy empire. The paradox of power. By 2022, BlackRock was managing $10 trillion in assets, more than any financial institution in history. It was simultaneously praised as a stabilizer of markets, criticized as a monopolist, and feared as a global overlord. The paradox was clear. It claimed to be a passive investor, merely tracking the market, yet it wielded active influence, voting on corporate boards and shaping policies. It was accused of being too woke for conservatives, yet too corporate and profit-driven for progressives. Larry Fink once described BlackRock as a fiduciary to the world. But what happens when one company holds such responsibility? Who holds BlackRock accountable? By the mid-2020s, the backlash against BlackRock was growing. Politicians called for investigations, activists demanded transparency, and competitors watched uneasily. But even as critics grew louder, one truth remained. BlackRock's grip on the financial system was so deep that removing it would be nearly impossible, shaping the future of the planet. By the mid-2020s, BlackRock's influence had gone beyond financial markets. It was no longer just about buying and selling stocks or managing pension funds. Increasingly, it was about shaping the future of the world itself, from how corporations approach climate change to how governments regulate technology. BlackRock had become not only the largest manager of wealth, but also a power broker in global policy, the climate agenda. For years, Larry Fink had been pushing the idea that climate change represented not just an environmental challenge, but a financial one. Climate risk is investment risk, he declared, signaling that companies failing to adapt would lose access to capital. This wasn't just talk. Through its voting power in thousands of corporations, BlackRock began pressuring companies to disclose their carbon emissions, adopt sustainability plans, and align with the Paris Agreement. Oil companies like ExxonMobil faced shareholder revolts. Supported by BlackRock votes, energy giants were urged to diversify into renewables. Banks were pushed to reduce financing of coal projects. This was historic progress, the financial system finally aligning with environmental goals. To others, it was terrifying. A single private company was dictating global energy policy. Critics argued, should an asset manager be allowed to decide the pace of the energy transition? The technology frontier. While BlackRock was steering climate policy, it was also moving into another frontier, technology and artificial intelligence. Through its Aladdin platform, the company was already analyzing trillions of dollars in assets with algorithms. But by the 2020s, Aladdin had evolved into something far more advanced, integrating AI to forecast risks, automate trading decisions, and even model global crises. Some insiders called it the financial brain of the world. What made this so powerful was not just the technology itself, but the sheer amount of data it processed. BlackRock could see patterns across markets, industries, and nations that few others could. In an age where data was power, BlackRock had more than anyone. This raised profound questions. Was Aladdin simply a risk management tool, or had it become an unseen regulator of capitalism itself? The political influence. BlackRock's reach wasn't limited to markets and corporations. Increasingly, it was shaping public policy. In the U.S., both Democratic and Republican administrations relied on BlackRock veterans for key economic roles. In Europe, governments consulted its experts during financial crises. In emerging markets, BlackRock's investments could make or break entire industries. Larry Fink himself became a figure courted by world leaders. He was invited to summits on climate, trade, and geopolitics. Some saw him as a voice of reason in a chaotic world. Others viewed him as an unelected ruler of the global economy. The critics strike back. By now, BlackRock was facing criticism from all sides. Progressives accused it of hypocrisy, profiting from fossil fuels while talking about sustainability. Conservatives accused it of social engineering, forcing woke policies on corporations. Populists accused it of monopolistic control, owning too much of everything. In Washington, lawmakers debated new regulations to curb its influence. Some proposed breaking up large asset managers, much like antitrust cases against big tech. Others wanted stricter rules on how firms like BlackRock could vote on behalf of shareholders. But BlackRock remained resilient. Its defense was simple: we don't own these assets. We manage them on behalf of clients. The power is not ours, it belongs to the investors. Yet for many, this rang hollow. When trillions of dollars moved at the click of a button, the distinction between managing and owning felt irrelevant. The global empire. By 2025, BlackRock managed nearly $11 trillion in assets. To put this into perspective, it was larger than the economies of Japan and Germany combined. IT held major stakes in almost every Fortune 500 company. Its technology monitored over $20 trillion in assets worldwide. In essence, BlackRock had become the central nervous system of global capitalism. IT influenced how energy was produced, how technology evolved, how governments responded to crises, and even how retirement savings of ordinary people were invested. And yet, despite its size, most people still had little idea what BlackRock was, or how deeply it touched their lives. As the world entered an era of climate change, technological disruption, and geopolitical instability, BlackRock's role only grew more crucial. But with such immense power, one question loomed larger than ever: who watches BlackRock? The future of capitalism. As the 21st century moved deeper into uncharted waters, BlackRock stood as both a guardian and a threat, depending on who you asked. Its influence had become so vast that it no longer made sense to describe it simply as an asset manager. To many, BlackRock was a force of history, a company that embodied the strengths and weaknesses of modern capitalism. The face of a new empire. Empires of the past were built on land, armies, and raw resources. But BlackRock's empire was built on capital flows and information. It didn't conquer nations with soldiers. It did so with investment. Every paycheck deposited into a retirement account, every pension fund contribution, every ETF purchase, these streams of money from ordinary people around the world pooled into BlackRock's ocean of assets. Through these trillions, it gained power that emperors of the past could never imagine. The ability to pressure oil companies into reducing carbon output, the ability to influence tech companies on data privacy and AI ethics, the ability to shape governments' responses to economic crises. And yet, it achieved all this without firing a single shot. Larry Fink's paradox. At the center of it all was Larry Fink, a man who began his career with a spectacular failure in mortgage securities, a mistake that cost his firm $100 million and nearly ended his career. That failure made him obsessed with risk, discipline, and control. Decades later, that obsession built the most powerful financial institution in the world. But with power came a paradox. Fink became the target of both admiration and hatred. He was the wise steward of global finance, guiding corporations toward a sustainable future. To others, he was the unelected king of capitalism, wielding power that no individual should ever hold. In interviews, Fink often described BlackRock's mission in modest terms: we are fiduciaries. We manage money on behalf of clients. Yet every year, his letters to CEOs sounded more like policy speeches than financial advice. The fragility of giants. For all its power, BlackRock faced vulnerabilities. Its dominance in passive investing raised the question: what happens when the passive bubble bursts? If too much money is locked in index funds, could markets become distorted, detached from reality? Some economists warned that BlackRock's size was itself a risk to the system. If it stumbled, trillions of dollars could evaporate overnight. Others worried about its dependence on Aladdin. What if the system failed? What if the algorithms miscalculated? Could a single glitch trigger a financial chain reaction across the globe? The irony was clear. BlackRock, born out of a desire to manage risk, had itself become the biggest risk of all. Democracy versus capitalism. Perhaps the greatest tension was political. BlackRock was not elected. It was not accountable to citizens. And yet, Its influence on climate, technology, and policy often exceeded that of governments. This raised a haunting question. What happens when private capital becomes more powerful than democracy itself? Some saw this as inevitable, the natural evolution of capitalism in a globalized world. Others saw it as dangerous, a concentration of power that undermined the very foundations of free societies. The world ahead by 2025. BlackRock's assets under management had grown to levels once thought impossible. Its technology scanned markets in real time. Its influence stretched from Wall Street to Beijing, from Silicon Valley to the oil fields of the Middle East, yet its future remained uncertain. Would it continue to act as the stabilizer of global capitalism, guiding markets through crises? Or would it become the Goliath that provoked a backlash strong enough to break it apart? Only one thing was certain. As long as money flows through the veins of global markets, BlackRock will be there at the heart of it, quietly pulling the strings. Epilogue: from the failure of a young banker in the 1980s to the creation of the most powerful financial institution in history, the story of BlackRock is not just about one company. It is the story of how modern capitalism works and how fragile the balance between profit, power, and democracy has become. In the end, BlackRock's rise forces us to confront an uncomfortable truth. The greatest empires today are not nations, but corporations. And perhaps none looms larger than BlackRock, the company that, whether we like it or not, owns a piece of the world we live in.